Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's episode is sponsored by Building Insurance and Risk. When you invest in real estate, work with the experts at Building Insurance and Risk. You will receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Todd Nepola. Todd is a commercial real estate investor and manager. He deals in retail and industrial properties, Class B and C properties. And they own and operate and lease and manage several million square feet of these properties. And in just a minute, we're going to speak with Todd about how to get started investing in commercial real estate. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Todd Nepola. Welcome to CRE PN Radio.
Thank you, Darren. Appreciate you having me.
Well, I'm grateful you're here, and I'm looking forward to our conversation today. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. Thanks. So we started the company Current Capital Management just over 20 years ago, and we're a full service management and leasing company. We don't really do much brokerage. I started that company because in the mid to late 1990s, I started buying commercial real estate for myself. And right around 2000, 2001, I realized I was paying property managers more than I was earning in my own job. So I took over managing my properties. And that led into people asking me to help them with theirs. So I wound up rolling into a company, which over 2 decades later, I really still enjoy and love every day.
I love that. I'm curious on that, just that notion and how you get started there. Do you find that that's a common predicament that investors find themselves in, is that the numbers seem to pay better to the manager than they do to the owner?
I don't want to say that too much because we're also a property management company, but you are right in the sense that the property manager has no risk, no skin in the game, and they just get paid a fee. So you're not an investor when you're just a manager, you're just fee based. So, it's definitely a nice plus, and it definitely can move the investment return of a deal, having a manager or not.
Sure. No, and I get that you guys are in that, but I would expect that there's a level of service that you can differentiate yourself and make it worth the fee, as opposed to somebody that's just getting the fee kind of thing. And let's back up here a second. I didn't mean to jump right into that. But if I read kind of the information about you while I was doing a little bit of research before this, correct? Did I understand that your family has been in real estate? Or did your grandfather how did you get into real estate before or what was there a family connection?
Absolutely correct. So I'll try to make this as quick as possible because now we're going back many, many, many decades. So my grandfather was a doctor and a surgeon, and that was going back into the 50s and 60s. And he started investing in commercial real estate. He never did any of the management because he was a full-time doctor. And then my father, when he graduated college, became an engineer. And he watched his father recognize how much money he made in commercial real estate, more so than even being a surgeon. And I think it was probably the late 1970s, maybe the early 80s. There was a recession. My father got laid off, and he realized he's better off working in real estate than as an engineer. And he shifted into commercial real estate himself. And I followed the same pattern when I graduated college in 1994. Everybody wanted to be an investment banker. So I went down that road, was working 80 hours a week, and said, wait a second, my dad owns properties and doesn't work at all and has all this money, so something is wrong. So like I said, in in around 2000, 2001, I shifted myself right into commercial real estate and never looked back. So I am following 3 lines of real estate tracking.
Well, I'm curious, the description there, it sounds like everybody did well in real estate. Was there a lot of interaction? I mean, were you conscious and aware of that being the case as far as your family being invested in real estate when you were growing up?
Well, to be fair, I didn't really know much about my grandfather's investment in real estate. I knew more about his investing in stocks because that's what he would talk about, and his being a doctor because he practiced that up to the last years of his life when he was in his late 80s. So I knew about that. But the investments he owned were similar to today's triple net deals. He wanted no headaches. He just wanted to park some money and clip a coupon. Back then, they used to even have, bonds that were bearer bonds where you'd actually get a coupon, and that's where everybody invested. So these weren't the kind of deals that I partake in today because they don't have the accelerated returns. There's no value add. So he didn't really need management. My father got more creative and started getting more into warehouses and land. And for me, from the get-go, it was always cash flow. I only want the deals that had cash flow. So we had it a little bit differently, but I'm the only one who's actually made a full-time career of it ever since.
Got it. And was there any kind of conversation, or was it just more of like it was in the background as you were growing up? Did you, with your dad, were you aware of it? It sounds like he shifted from being an engineer to a more of a full-time investor, but was that, how aware of it were you? I guess I was trying to understand that.
Sure. Well, with my father, I was very well aware of it because he had his engineer background. So he was always creative in the way he would buy, say, an old building, and he could figure out angles to cut the building, change the building. He would take a 1-story building and cut off half of it and add a 2nd story in the back because he could figure out the loads and the weight calculations back then. So he was more creative, and he would bring my brother and I to the sites, and we would get very involved, whether it was playing on tractors when we were, young, or actually putting us to work when we got a little older. So I was very, very well aware of it then, yes.
Got it. And so you mentioned in college, the investment banking route was kind of your first thought. Was that like a sense of just to follow the kind of the career path that everybody was chasing, or was that more of like, was it rebelling, or was there a not wanting to do real estate, or was the real estate not even a thought?
Well, the real estate for me, the way my dad had it, wasn't really a thought, or I wasn't even welcome because he didn't have a business per se. He just owned real estate assets. So there was really no place for me to fit in there. At that time, I think everybody probably saw the movie Wall Street with Michael Douglas and said, boy, it'd be nice to wear those suits and make all that money. But they didn't show us how hard you actually have to work. But so I went down that road. And, if you remember the 1990s, it was you pick a stock and it just went up. So we were all geniuses. Right. The problem I had was that you were only a genius when you did a trade, and you only got paid when you did a trade. So if I took a week-long vacation, I made zero. And that's when I started looking back at my dad and other people. Back then, there was a lot of infomercials on TV, and you saw these people, whether they were selling payphones for, cash flow or real estate. I realized something's got to give, or I'm going to be working 80 hours a week for the rest of my darn life, and I don't want to do that. So that's when I started to say I wanted to get into real estate. So I started my first transaction, I think it was 1998, June 98, and I bought a warehouse. And back then, nobody wanted to own real estate. Right? You could just pick it up anywhere. So I was pretty lucky in my timing that I wanted to own it. I knew I wanted to own it, and nobody else did. So it's the opposite of today.
No, that's awesome. So you mentioned your first property was a warehouse. Was it local to where you were living, or where was it? Where was it located?
Yeah, so it's very close to where I was living. I would say it's probably about 3.5, 4 miles from my home. And I like to tell the story because I'll tell it quickly, but I tell it because so many new investors get hit with this hurdle and they stop. So when I went to buy this property, like I said, I was working for years as a stockbroker and investment banking. I saved all my money, and I went around looking for properties for sale. Back then, there was obviously no internet sales or LoopNets and CoStars. So you would drive around and you'd find the sign, or you'd find it in the local paper. This property had a sign for sale, and it was a foreclosure that was being sold by the bank. I had agreed to buy it. I agreed the purchase price was $575. And because there wasn't a lot of loans at the time, the bank said, if you come up with 50% of the money, they were the owners as well, we'll finance 50%. And I scratched and clawed and did everything I could to get every penny I had. I had $50 left in my bank account, and everybody, and I mean everybody, told me I was crazy to buy this property. They told me that I was going to lose my money. It was never going to work. Nobody wants to own real estate. It's a bad investment. But I was determined to not just prove them wrong, but also to make some money. So I bought it in June of 1998. It had 7 tenants. It's 13,000 feet. And between June and December, I had 4 vacancies to fill, which I did. I personally went with my friends because we were all in our 20s at the time. I got cheap labor. We painted the building. We cleaned out the empty bays. We threw down sod. We seal coated. We did everything ourselves. And in December of 1998, I refinanced the asset for $600,000, got all my money back, paid all the closing costs. And from that moment on, it was $5,000 a month cash flow positive. So everybody, including the lawyers who told me I was crazy, all of a sudden thought maybe you're not crazy. Now I was just lucky. And I just kept on rolling. And here we are, 24 years later. I guess the luck is still continuing, knock on wood.
I love it. I love hearing the how you got started story there. So you get the first one and you make it, or you fill it, and you do a lot of the work yourself there in the beginning. Refinance, get your cash back, and now you've got a cash flow. I mean, who doesn't love cash flow? So at that point, did you continue to work as a investment banker, or were you like leaning towards doing the real estate, or what was your?
Yeah, I was still working as a stockbroker and a banker because it was a great time. Plus, I was a young guy. I'm in my mid to late 20s at this point. I was 26, 27 years old. So I was having a great time. So, I was a single guy hanging out with groups of guys going out at night, but I was doing my real estate business late at night or on the weekends. And sometimes I would work till 2, 3 in the morning in the property, being at home, figuring things out or putting ads in a newspaper. And then I would just roll with that. But I knew I wanted to do more. And once I had my money back, I started hunting for the next one, which I found about a year later. And it was on the same street and it was the same thing. It was a sign out front. I called and I bought my second one for $475,000. And this one had seller financing. And I put $100,000 down. He financed the rest of the loan. I remember his name, George Zartolis. That was that many years ago. Great guy. And I bought this property, did the same thing, moved some tenants around, recreated it, repositioned the back lots that were vacant. And this one I didn't refinance because I had seller financing, but I still had more cash in hand. So then I went and started buying an office building. And it was around 2001, I would say, that the market for stocks and bonds and everything just imploded and nobody wanted to touch it. And like I said, I now had people helping me. I was paying so much money to. I said, I just do it full time. I don't need to do it, and I'll focus only on real estate. And it was from that point that I just stayed with real estate. But I always missed the brokerage, and I watched the stocks all day long. I still enjoy it, but there's nothing better than real estate.
Yeah. No, I just love the creating the cash flow. To me, that's the appeal. I can remember, years and years ago, the network marketing kind of the appeal was, you can make money in your sleep kind of thing, and the reality is really real estate is that kind of tried and true, very traditional, time tested path to cash flow. And you're singing the song, and everybody else I know is wanting to join in, so. So let's talk about, you mentioned a couple of things there about financing. The first one was a bank owned property. And it sounded like to get started, you had to come up with 50%, but was it less than a year? It sounded like that you were able to refinance and get your money back out. At that point, were you, what was the percentage of your equity in that property when you refinanced it?
All right. So when I bought it, we got it for $575,000. And like I said, 4 units out of 7 were vacant. And I had never done a deal before. So getting a conventional loan was going to be tough. So this would have been a very tough deal if I didn't have some money. So like I said, I took every penny I had. I borrowed money from friends and family, everything I could get to get the 50% down. And by doing that, the bank that actually had the property, because they foreclosed on it, it was called Gentra Bank out of Canada. They agreed to lend me 50% if I had 50%. And it was just 6 months later that the property was full, stabilized, and proof of income was there, that I got a local lender. I forget that one, which bank that was, but a local lender came in. The property appraised for $800,000. They lent me $600,000. And from there, I just got the bug and realized that I'm onto something here.
Got it. And as far as the terms there, do you remember the interest rates you were getting back then in late
Yeah.
90s?
I remember. That's funny because now everybody talks about interest rates today. The first deal I did when Gentry gave me the loan, they gave me the loan at 10%. And when I refinanced it, I was so excited because I got 9% interest that I thought this is great going at 9%. And I've been on a lucky trend for the last 20 years because it's been nothing but down interest rates. But now people hear 6%, they think it's the end of the world. I mean, and I remember before that, even before I was involved, where 13, 14, 15% was an interest rate you could see. So I don't think we're going back to that neighborhood anymore, but certainly was an interesting time. But 9, 10% was a great loan.
Yeah, no, it is. If you've got, if you've been in the game or been borrowing money for any length of time, you've had a chance to see those higher interest rates. I know, I think the first mortgage I had for a house was like 7 3/8, and we were doing cartwheels because we thought that was such a great rate compared to what the market had been. And now people freak out, like I said, 4 or 5% on a home loan, and so it'll be all right. But anyway, so so you started out, you started acquiring properties. Uh, you decided to make it a full-time thing. You started managing your properties. Um, when you started managing your properties and others started coming to you, were you still acting, or were you operating solo, or did you have a firm, or at what point did you formally, um, become a firm and manage for others?
Like I said, I kind of stumbled onto it on accident because I was managing and leasing my properties. And back then, it's not like today where everything was full. At least in South Florida, everything is full. I actually had to go out and work, and I would go door to door. I would make flyers and go door to door, whatever I had to do to lease the properties. So I remember the first person that came to me was a dentist. It was someone I knew. It wasn't my dentist, but a dentist I knew. And he said, "How come your properties are always full and mine's not?" And I said, "Because you're a dentist all day and I'm not." And I go door to door. And he said, "Would you lease my stuff and help me with mine?" And I said, "Sure." Now, I guess the statute of limitations is up. I didn't even know you needed to be licensed to do this. I said, "Sure, I'll help because I do it for myself." And I charged him $500, which probably would have turned into tens of thousands of dollars if I knew what I was doing. But it led to that. And I realized, wait, I could help this guy. And then I filled his center. Then he referred me to his cousin. And then I got another property. And that's when I said, oh, I should get my brokerage license and do all this. So I went and took all my tests and got licensed. And that's when I learned, wait a second, the commissions aren't $500. They're much higher. So then it rolled into that. So between managing mine and managing others, believe it or not, people don't know this, but when things are really hard, it's actually the best time to be a property manager or leasing agent because there's some velocity and people need help. Right now, everything is full and tenants have the money to pay the rent. So there's not a lot of product available for rent. So I was able to do very well at that point by leasing other people's products. And then I was using all my cash flow to go out and buy more properties or renovate my properties and do little things to mine. So it worked out very well.
No, it's great. As you were acquiring properties, was there a point where you felt like, because it sounded like when you first started, I mean, the $5,000 a month was coming in, but as you own properties and stuff, there's little things that come up, whether it be a capital improvement or taxes or insurance or whatever it might be. When you made I guess you said that when the stock market kind of in 2001, when nobody was wanting to do stocks, that was kind of the jumping point to go do this full time. Was there a sense of risk in your mind, or was it a sense of more like this thing's working? We're going to make it really work.
Yeah, I mean, I figured out that it was working, and this pattern and this could be replicated time and time again. I've always been a very big reader, so I started reading everything I could from guys who have been doing this for 30 or 40 years. And I said, they're doing the exact same thing I'm doing. They're just doing it bigger and better, but we're all doing the same thing, and it's worked for them for decades and generations. So I knew it would work. Just the question is the deals. Where I will tell everybody, and I'm always very honest about this, is where I made my biggest mistake was I started to live off of some of the money from the properties too. And while everything was fantastic and going great, and I started getting myself a bigger house and a toy car and a boat, and I started to feel wealthy all of a sudden, well, the real estate market decided to change course in 2007 and 8. And none of the properties were at risk because I didn't have too much debt, but the tenant who was paying $2,000 was now paying $1,500. The one that was paying $1,500 was now paying $1,000. So I always covered the debt service. I could always pay the bills, but I had just gotten used to a lifestyle where I needed that money to pay my bills. So I started watching my personal savings account go down very rapidly. So I had to course correct very quickly. And then, like I said, I kind of got a little lucky there too, because a lot of people really needed help. And that's when I really built the management company up very, very strong. I'd say from 2008 to 2000, probably 12, 13, we had some great, great years in development here. And that's when we shifted over to a lot of third party work. But I got a little too greedy living on the money.
Well, and I think that's a good lesson right there for the listeners and anybody in real estate. Is it is easy to kind of think the trend line only goes up, and you know, when you have some sort of an economic change that happens, whether it be a recession or interest rates or just times get tough, everybody looks to try and cut expenses, and including tenants. And it sounded like you were able to negotiate with your tenants as opposed to have them leave based on the rent reduction kind of thing. And like you said, you were able to continue to cover your debt. But that's a huge lesson, because I think that a lot of times my concern is when I talk to people who haven't been in this very long, they got in post '08, all they know is a market that's been going up.
That's right.
And bought at the bottom, and it's not really, you don't have to be a genius to buy something for zero and let the market rise, but to really have to kind of tighten the belt and recognize that there's other variables in play. And if you have something that's coming up for a refinance or something like that, and all of a sudden your rates are going up, and that cash out refinance you were counting on or whatever, it can change your outlook. It can change the way you have to operate in order to continue to operate. And I love hearing somebody that's been in it long enough that understands and has weathered the storm and righted the ship, kind of thing. So thanks for sharing that. So let's talk a little bit about the first time people that are trying to get into real estate. As far as when you're working with people or talking with people that are looking to get in, do you have any kind of a rule or recommendation as to like the location where they start, or the asset class, or to go solo or to try and join with others? Is there any kind of a path that you recommend?
Yeah, I always say it depends on the investor and what they really want to do. So some people are very hands-on, and some people are control freaks, in which case they should not partner with anybody. They should buy a smaller property and own it and control it themselves. Some people, say your architect or dentist or surgeon per se, has no time to deal with a leaking roof or a tenant issue. So they should partner up in a GPLP structure and invest in someone else's deal, which is just as good. But if you really want to get in the game and get your hands dirty, you got to buy your own property. But you got to be honest with yourself if you have the time. Like I said, when I got started, I was 25 years old. I was a single guy. I didn't have a wife or kids. So I really had the time. There was no reason why I couldn't come home from work and work on my deals. Today, I'm married. I have 2 kids. I have 2 stepkids. I wouldn't be able to stay up at night working until 2 a.m. My wife wouldn't like it. She'd be on the computer wondering what I was doing there. So things change. So you got to be honest with yourself what you could get. And I also should add, you have to be honest with the returns. So I got very, very lucky because the first deal I did worked out so well. But the second deal I did, like I said, I put $100,000 into it, but I knew my return on that deal, which isn't horrible, was only going to be around $700 or $800 a month. And you're right, what you mentioned before. What if an AC blew? What if something happened? So I didn't think that far ahead, and things like that did happen. But when I told people I put $100,000 down on a property and I expected to get $700 a month, they thought I was crazy. They said, why would you do that? Leave the money in the bank or buy stocks, buy bonds. That property I bought for $475,000, I wouldn't sell it today for $3 million. But I had to have the patience to hold it for 20 years. And that's what people don't understand. Now it pays me quite a bit more than $800 a month. But you have to be patient going in and realize that the return, the number won't be so big. And like you said, you have to save for that rainy day, but you have to be patient and you have to know what you're going to be good at. So that's the key. Whether you invest in someone else's deal or yours, it's a very personal situation.
No, I love, just the kind of the perspective you've got of having, done it. And what you said there, I think is something that people a lot of times don't realize or don't think through is just the need to invest and wait, kind of thing. You mentioned you paid 400 and some for that one, and you wouldn't sell it for 3 million today. I'm assuming that even if you take inflation into consideration, that you've far exceeded the um, the returns of what you could get, like in the market. Do you have any kind of sense of that?
Absolutely. I mean, I don't know the actual number, the percentage return is, but South Florida has done extremely well. And I would say the whole state's done very well, very, very well. But my catch is when I would go in and buy properties like this one I bought, like I said, the gentleman's name was Zartolis. When I bought it from him, he lived out of state, he lived in Connecticut, and he let the property get run down. So from the moment I bought it and I repositioned the tenants, which were in the wrong places, and I moved things around and I fixed the buildings up, and I used every bit of cash flow that I had coming in to paint the building. I did some stucco work, even little things back then, like changing the lights and adding some sod, or I took out some areas where there was nothing and put some extra parking spaces. I rented it to a guy with a boat. I got very creative. So very quickly, the property was worth a lot more than I paid, but he had me locked in with the prepayment penalty on his loan. That's how I got the deal. So I just left that one alone for probably about 10 years. I didn't refinance that. But you have to get creative with your deals if you're going to be hands-on. It's very, very tough to make a lot of money if you're just going to go out and buy a Starbucks, because Starbucks is in place, the lease is in place. So what you're going to get is what you're going to have. So I prefer properties where maybe Starbucks used to be and it's empty, and I got to get creative and refill this asset.
Got it. You mentioned, or we were talking primarily kind of warehouse flex space, and you mentioned you purchased an office building. Is that primarily the asset classes that you invest in or that you manage?
We only focus on retail properties and industrial properties. And I did say I did an office. I did buy 2 office buildings. And I have to tell you, for me, I know that they work out very well for some people. For me, I hated it, because every time a tenant wanted to move out, the next tenant would come in and, well, this office wall has to come down. This door is not facing the right way. And it became so expensive to turn the units. And then you'd have tenants stay. Now, today, it's easy to monitor stuff like ACs. But back then, I would have a tenant go in the hallway and pop the little thing off the wall and lower the AC down to 65 and stay all night. And I couldn't control the expenses. So I was very happy to sell these office buildings and get out. And I've never gone back into office again. But it's still a good asset class. It's just not for me.
Yeah, no, I think with COVID reset, there's going to be some opportunities if you're looking to get into that asset class, that's for sure. So, as far as location, are you primarily Florida based with your operation and the assets that you own and manage?
That's correct. So my belief, my philosophy, whichever one you refer to it as, is that I want my properties to be a driving distance within a day. So I like to buy properties that if I got in my car in the morning, it's no more than, say, a 4-hour car drive to get there. So I could drive to my properties, see what I need to see, deal with what I need to deal with, and drive home and be home for dinner. Maybe a late dinner, but be home for dinner. So everything we have is in the state of Florida and on the East Coast.
Gotcha. And as far as your management, do you have staff that does all of the operations, or do you subcontract out a lot of the services?
When I first started, it was a team of 1, me. And I remember I got my first employee, that was going back many years ago. And then from there we grew. So now we're 30 people in-house, but we only do the management work and the leasing work. So if there's roof work, paving work, landscape work, everything is subbed out, and we sub it out in different areas. Because, some landscapers are great in, say, Port St. Lucie, which is 100 miles away, but we're too far in Broward County, where I am right now, which is, like I said, 100 miles. So we sub everything out. And I also find that keeps the vendors on their toes if they know you have multiple people. So everyone's always hustling a little harder.
Yeah. So when leasing a commercial, or actually when acquiring a property, and I guess is managing it too, can you talk a little bit about some of the aspects of like a commercial retail space, as far as, is it rent on the square footage, or is there, do you do what's the other one, net or whatever, where it's based on their receipts, or what's the standard that, or what's primarily the way you guys go on leases?
We do any lease that's just going to be, we'll do short-term leases. So if a lease is 1 year or 2 years, we can do a gross lease, which is just a flat rent. You pay this, you know your increase the next year, and that's the end of it. Most leases we do are called triple net, which means the tenant will pay his rent and his pro rata share of all the common area expenses for the properties. And those has to be the way for all longer term leases. And we have in there fixed increases and or CPI. And a lot of people got used to the fixed increases being 3% or even 4% until last year when CPI was 9%. And all of a sudden they saw a 9% increase. But if we hadn't had that in our leases, we would be in a bad place today because the leases wouldn't have appreciated as much as inflation. So you have to have stuff like that in place. But we're happy to do leases on 1 year, 2 year, 5 year, 10 year. Just depends on the tenant, the credit, and what the tenant really wants.
Got it. So when you're looking for a kind of a two-part question here, if you're looking for an investment right now, for you personally, what are some primary things that you would be, looking for? What are some key things that you would be paying attention to?
I look for a lot of things. That's a long answer, but the main thing I'm looking for is a way that I feel my team and I can add value. And that doesn't mean I'm going to steal the property, because the last property I bought, I probably got it around the 6 cap or 6.5 cap. But I know there's out parcels that I could try and do some work on and add value. I also look for properties that have been owned by the same family, same owner for a long time. Because a lot of times what I found is that people, I don't want to say they get lazy, they get comfortable in their rent increases and they build a relationship with the tenants. So a lot of times you'll find those tenants are far below market. So we just bought a property in April and I have tenants that are paying $9, $10 a foot in a $15, $20 a foot market, just because they've been there for so long. So I like that risk arbitrage, because if the market comes down in 2023 or even in 24, if the market comes down and rents come down, those rents where I'm buying it at are still far below the market. If the market stays neutral to where it is today, I have a lot of room to move them up. I wouldn't dare move them to market, but I have a lot of flexibility. But if a tenant leaves, it's actually a good day for me. So I'm trying to judge the risk on the downside more so than even the upside.
Yeah, no, I think that's I love your philosophy there, looking for where you can add value and finding something that you can make more valuable. I'm curious, when you bring on new properties to manage, is that kind of a similar philosophy there? Is it? I mean, do you find that some of the people that you're bringing on kind of were not paying attention to the market rents and that kind of thing?
Yeah, what generally happens is when people come to us for help is when they have a few vacancies, because nothing annoys a landlord more than a vacancy, because you'll never recover that rent. So that's when they really want to come. And when they see what the market rent is, they weren't even aware, because if the tenant they had, Mary's rent in the restaurant was $2,000 a month, but they became friendly with Mary and they just raised for $100 every year on the rent. So now it's $2,100, $2,200. Well, the market might be $3,000 a month. And they didn't realize that, because this is what they're getting. And they're making a lot of money because they've owned the asset for a long time. So they're okay with it. But then when they realize the value they could be getting, someone usually chimes in and says, hey, we need to fix this. So that's when they bring on a management company. So we're the bad guy, and we're the ones who are brought in to reposition the property. So now Mary's rent, instead of being $3,000, may go from $2,200 to $2,650 or $2,700. And the owner never wanted to have that conversation. And the vacancies will go to market rate rents. And that's when they realize that it's important to have a manager, because we lose track of our own stuff, just like our own house. I always say we move into our house. The day we move in, we want to paint it, change the cabinets, change the bathrooms. And then we look at it 10 years later and we haven't even painted. So you get excited when you get started, but then you get a little bit too comfortable.
Right.
So we're the bad guy.
Right. Well, I'm assuming if there's been a hesitation on the property owner to have that conversation and increase rents, and maybe there was even a reluctance to pay a management fee. I'm assuming that when they see the returns they're getting, having management that does keep the rents up and keep the property filled, they're fans of yours forever. Do you find that to be? I mean, are most of them like, wow? I would think there's some excitement.
I'll tell you real quick. We have a client. I love her, and her son came to me. I think that she's now probably well into her 80s, but her sons run the property, and they're my age. They're in their 50s. And she came to me and she had a warehouse that her husband used for many, many years. And it was 15,000 feet. And they rented the warehouse to one woman who was a car dealer. And it was actually 5 units, but she took the whole thing. And she was getting $2,500 a month. And it was the most ridiculous price I ever heard, but she didn't know. So she rented it. And the tenant actually wasn't even paying the rent. So the
Oh my
sons
gosh.
called me and I met and they said, we don't have to do. My mom can't pay the bills. And when I heard this, I said, I don't even know what you're doing because you should be getting over $2,000 a month per bay. So we went in and we made the hard decision that we were just going to throw the tenant out. The tenant was mean and nasty on the way out. She did a lot of damage, but I had to put my arm around them and insure them. I said, please just give me a chance. Luckily, the first month we rented 2 bays for over $4,000 a month. And right now that units, I think we're getting like $15,000, $16,000 a month in rent this many years later for the whole warehouse. And every time I talk, he's like, my mother loves you. It's all she had was one warehouse. She wasn't really a real estate investor. It was the family's thing, but they just didn't realize the market. They never went over there. Neither did the sons. So when they brought on the management, we more than pay for ourselves. And guess what? We now collect the rents. We pay the sales tax. We pay the bills. We deal with the headaches. They don't think about anything, but they're making 5-6 times the money they were making.
No, that's I've got to confess, I self-managed more of kind of habitational stuff for years. Just that's kind of what I did, kind of talking about hands-on kind of thing. But I am a fan of management. I've realized I'm a better asset manager than I am a property manager, and that's important to realize, where you fit in the picture kind of thing. And there's a skill set. I mean, if you don't have that skill and you're not in the business on a regular basis, you're not going to do as well as you can with a property manager that's in the business,
Right.
and can knows what the market is and is they're adept at having those conversations, and they have the contracts, and they keep it working like a clock. So I'm a big fan of management. So, but hey, Todd, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, the market, tenant laws, political interest rates, however you would like to frame the question. But if you could take a look at your situation and consider what is the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Todd Nepola, what is the biggest risk?
Well, I know you said you don't want an insurance or need an insurance answer, but I'm going to tell you, as a real estate owner, your biggest risk is not knowing and working with a good insurance broker. So I'll give you a real quick story again, that the second building I bought, one of the guys I rented space to, he stored tires, and the tires caught on fire. And when I was told that that there was a fire, at first I thought someone was kidding me. I drove there, saw the whole street shut down, and it was burning 50 feet to the sky for just a few tires. I mean, maybe 50, 100 tires. And when I asked the firefighters what they're doing, they said, there's really nothing we could do. It's just going to burn out. And I was like, oh my God, my whole building burned down. And it did. And when I went and called the insurance company, that was my next call first thing in the morning. I got a hard lesson in insurance about being underinsured and the values were off. And I realized that I was on the hook for a lot of this damage. I was going to really eat it. And I said, this is terrible. Nobody ever explained this to me. I just assumed you buy insurance if there's a problem. What saved me is that it was a total loss. And by being a total loss, I had to pay the maximum insurance policy. Then they gave me money for demolition and cleanup. So I was saved. But had it only been a fire that was contained to one room, I was really going to pay the price because I wasn't properly insured. So that went back to probably around 2005 or 6, that fire. And ever since then, I said, you really, really must work with the good insurance agent, especially in Florida, as we're talking now, it's storming outside. If you're not aware of your liabilities on hurricane insurance, wind insurance, fire, slip and falls, people don't know things like, it won't be your fault. Someone could fall on your property and you'll do nothing wrong, not even have a pothole, but you're going to get sued. So what are you exposed for? And I find every time I take on a property management account and I ask owners this question, they simply don't know. And that's why it's really, really important you work with a good insurance agent. That's more important than tenant risk, because if a tenant leaves, I can replace it. That's more important than a problem with the vendor, because I could get a new vendor. But if you're not properly insured and something happens and you're going to share this liability and you're not ready for it, it could bankrupt you.
No, I love your answer. And it's always nice to hear it back from somebody that's been through it, as opposed to somebody that's, I think a lot of times it's really easy to get into the limit, price, low price wins kind of thing, as opposed to understanding what the coverage is.
Yeah.
And so I appreciate you taking the or sharing that, because it does. I mean, you are lucky that it was a total as opposed to partial, so a little co-insurance lesson there. So
yeah, you really have to know what your exposure is, because everyone's looking over here, but something like that we say may never happen. And then we complain how much insurance goes up. But when you need that insurance, it's like health insurance. You don't want to go to a hospital without having health insurance. So you need that insurance, and someone has to explain to you what you're covered for, so you know.
No, I love it. Hey, Todd, where can the listeners go if they'd like to learn more, connect with you?
All right, well, a couple of places. You could certainly see our website. It's currentcapitalgroup.com. And if you want to see me personally, I'm on Instagram at Life According to Todd, and I talk about real estate quite a bit as well. But the last thing I'm just going to pitch here, if I may, is I've always wanted to give back. So what I did is I decided a year ago I was going to write a book. But to show what my intentions were, I said, people come up to me all the time and ask me about buying real estate, but they're asking the wrong questions. Just like we said, they're not thinking about insurance or the rainy days. So they ask me questions and then I answer them and then they walk away. And I said, they really didn't ask me the right question. So I said, I would like to write a book that I could give to people where I would answer the questions that are really, truly important, and they could take this home and read. But I didn't want people to think that I had a vested interest in this, because I truly wanted to give back. So I wrote a book. I wrote it myself. It's published now, and 100% of the proceeds are going to charity. They'll be real estate related, but 100% is going to charity. So the book I wrote is right here, Keeping It Real on Commercial Real Estate by Todd Nepola. And it's a nice book. It's 200 pages. I give you pictures about real estate deals I've done. I give you everything. But I wrote this book for charity. And the truth is, it's got a lot of great data, almost 30 years of experience put into this book, of all the pitfalls I've experienced and all the prosperity I've experienced. It's right here. So if somebody wants to learn more about real estate, they should buy the book. It's for a good cause. And they should continue watching podcasts like yours, because that's how you learn. This wasn't available 30 years ago when I got started. And that's why I agreed to do podcasts like this, because it's such a great business. And I hear so many kids coming out of college now. We have interns here every year, and they don't know really what they want to do. I think there's no better asset class to invest in than real estate. You want to be a doctor, you want to be a Bitcoin trader, I don't care what you want to do, but you should invest in real estate, especially when you're in your 20s, 30s, and 40s, because you have time. So that's why I wrote the book. So hopefully your fans will take a look at that book and see it on Amazon and give it a buy. It's for a good cause.
No, I appreciate that. I'll be ordering mine today.
Thank you.
Hey, Todd, can't say thanks enough for taking the time to talk today. I have enjoyed it thoroughly, learned a lot, and look forward to doing it again soon.
Thank you so much. I really appreciate you having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.